In the next 24 hours, I need to figure out how to buy every stock in the United States. There are nearly 5,000 public companies in the US and I want to own all of them. That sounds crazy now that I say it out loud. But we need to get this done today because a recession is coming and I can't risk owning the one or two companies that go bankrupt. It's all or nothing. Begin. First things first, let's get a list of every stock that we'll need to buy. I know the two main places where public stocks are listed in the US are the New York Stock Exchange and the Nasdaq. So that's where we'll find our list. Okay, I found a website that shows all of the stocks that we'll be buying. And the first thing that I'm noticing is the volume. There are a lot of companies here. I mean, this is just the page for stocks beginning with the letter A. But I won't let that put me off just yet, so let's keep going. Next, we need to figure out how we're actually going to buy these stocks. I don't live in America, so it's not like I can just show up on the doorstep of the New York Stock Exchange and order one of everything off the menu. I'm pretty sure that's not how it works anyway. Hello, sir. For my main, I'll take one of your finest stocks in Amazon, please. And for dessert, I'll go for an apple. So instead, we're going to use what's known as an online brokerage app to buy our stocks. These are apps which allow regular people to buy stocks from anywhere in the world. I'm personally using this app called DeGiro, but there are lots of options like Robinhood, Trading 212, and Interactive Brokers. Now that we're set up with our broker, let's get to buying these stocks. The first thing I want to find out is how long it's going to take me to buy 5,000 stocks. Because remember, we have to get this done in 24 hours. So I'm taking a sample of 5 company stocks and I'm going to calculate how long it takes on average to buy one stock on this app. Before I reveal how long it's going to take me to buy all 5,000 stocks, have a guess for yourself and leave a comment down below. Alright, so it took me 115 seconds to get to the confirm order button for all 5 stocks. With some quick maths, that works out to an average purchase time of 23 seconds per stock. With 5,000 stocks to buy, that's a total of 115,000 seconds, which is 1,916 minutes, which is 32 hours. Okay, we've hit our first roadblock. It's going to take too long to buy one share in each of the 5,000 companies, and even though I'm not surprised, I am pretty disappointed because I did like the idea of owning all 5,000, but we're going to have to make a compromise. So now we need to figure out how we're going to narrow down the stocks we have to buy while also somehow sticking to our original target of owning every stock in the US. That makes no sense, but here we go. Again, to remind you why I'm doing this, in a recession, stock prices can go up and down quite quickly. So it's not a good idea to just own a handful of stocks in case you end up with a handful of losers. You're much better off owning lots of stocks and spreading out your risk. That's called diversification. All is not lost. So I've been doing some more research on US stocks and I've stumbled across the website for S&P Global. These are the guys who came up with the S&P 500. Now, if you don't know what that is, it's essentially a list of the top 500 most valuable companies in the US. Companies like Apple, Microsoft, Amazon, Tesla, and Google are all on this list. But what's most important for us is that right here on the website, you can see that this list of 500 companies accounts for 80% of the total value of the US stock market. So here's the compromise. We reduce the amount of stocks that we have to buy from 5,000 to 500. And by buying these 500 stocks, we'll still be covering 80% of the total value of the US stock market. In other words, 10% of US stocks account for 80% of the total value of the stock market. And we're buying the 10%. And because the 500 stocks which we're buying represent the most valuable companies, that means we're also investing in the highest quality stocks, which is great for a recession. So we're back on track. 500 stocks at 23 seconds per stock is 191 minutes, which is just over 3 hours. So that gives us plenty of time to sit down and buy these within our 24-hour window. So what I'm going to do now is make my way through this list and buy one share in each of these companies. So for example, we'll be starting with Apple, and that's going to cost us $173. I forgot that stocks weren't cheap. Okay, so I need to calculate how much it's actually going to cost to buy one share of each company in the S&P 500. But before I do, have a guess on how much you think it's going to cost and leave a comment down below if you're feeling brave. At this stage, I was feeling nervous because the results of this calculation could be a make or break for the video. I did have a pretty restricted budget to work with, so if it turned out to be too expensive, it was potentially game over. That was actually pretty painless to calculate, but I wish I could say the same about the results. If we want to buy these 500 stocks, it's going to cost us $87,641.09, which I do not have.
Hello?
Claire?
Yeah?
Could I borrow 87 grand for a video, please? Hello? That's not happening. Okay, so second roadblock. Even though we've managed to narrow down the amount of stocks that we need to buy to 500, it's still too expensive to actually buy them. If it's going to cost us 87 grand to achieve our target of owning the US stock market, then it's not going to be realistic for us to get this done before the recession, let alone within 24 hours. We could settle for narrowing down this list even further to just buy the amount of stocks that we can afford, but that's not going to provide us with the same kind of high quality diversification that owning all 500 would. I will need to think about this one a bit more, so leave it with me. I'm sure it won't take too long to figure out. 6 hours later. Well, that took a lot longer than I thought it would, but I think I might be onto something. Remember earlier we were talking about the S&P 500 and we said that it's a list of the top 500 most valuable companies in the United States. Well, turns out it's more than just a list. It's what's known as a stock market index. So I looked it up, and the word index in the English language is defined as a measure of something. So a stock market index is a measure of the stock market. But the stock market is a big place with nearly 60,000 companies listed globally. So lots of these indexes were invented to measure certain parts of the otherwise extremely large stock market. The S&P 500 index, which is the one we care about and is represented by this chart here, measures the stock performance of the top 500 stocks in the US. So that got me thinking, what if it was possible to invest in this index? And if it was, would it be cheaper than buying each stock individually? Because if the performance of this single chart represents the total performance of the 500 companies, then if we could make such an investment, we would technically own all of the 500 companies without having to buy each one individually. For example, I can see that in the last 5 years, the S&P 500 index as a whole has increased in value by 77%. Some of the stocks included on that list of 500 will no doubt have increased in value by more than 77%, some by less, and some will have decreased in value. But all we want to know is what the end result would be if we owned all 500, which is what the index is telling us. So if we can figure out how to invest in the index, and provided it's affordable, I think we can own every stock in the United States before the recession. So let's give it a shot. This part of the process was probably the most time consuming because there were lots of terminologies being thrown around in the articles that I was reading. But what I found really got me excited. Okay, I think we could be in business. So I pretty quickly figured out that you can't invest directly in an index. As this website puts it, an index is a hypothetical basket of stocks. And so it's not possible to buy stock in the S&P 500 index because it's not real. It's just used for illustrative purposes. But what is possible is buying stock in what are known as index funds. And these are used by investors to allow them to invest in an index. So here's the lowdown. Way back in 1976, a guy named John Bogle was asking the same question as us. Is it possible for the average Joe to own the entire stock market? John believed it was, and here's what he did to make it possible. He set up an index fund. He gathered money from lots of different investors, and he used that money to do what we tried to do earlier, which was to buy each of the stocks in the S&P 500. But here's the genius part. He then gave shares in the index fund to the investors who had given him money in the first place to buy the stocks. Now, let me show you an example to showcase the beauty of this and why I think it's the solution to our problems. So earlier we figured out it would cost us about $88,000 to invest in each stock in the S&P 500, which was obviously far too expensive. But what if we gathered 39 of our friends and we agreed to split the cost of that investment equally among the 40 of us, which would be $2,200 each? Okay, but how would that work, and how would we decide who owns what? We give our money to Mr. Bogle, who has set up an investment fund, and he uses our collective $88,000 to buy one of each stock in the S&P 500. He then says, okay, I'm going to create 10,000 shares in this fund and I'll divide them up between the 40 of you. So each investor gets 250 shares in the fund. On the first day he does this, the investors want to know how much each one of their shares is worth. So Mr. Bogle takes the value of the fund on day one, which is $88,000, and he divides it by the number of shares in the fund, which is 10,000. That gives each share in the fund a value of $8.80. When each investor multiplies their 250 shares at $8.80 per share, they realize that their investment value is $2,200, which is the amount they invested in the first place. Mr. Bogle then comes back 1 year later and he sees that the value of the 500 stocks collectively has increased to $100,000, which is an increase of 13.6%. Once again, the investors want to know how much their shares in the fund fund are worth. So Mr. Bogle takes the new fund value of $100,000 and divides it by 10,000 shares, giving the fund shares a value of $10. Each investor multiplies their 250 shares, this time by $10 per share, to find that their new investment value is $2,500, which is also an increase of 13.6%. So do you see what's happening? Even though each investor only owns 1/40th of each of the 500 stocks owned by the fund, their investment value is still growing at the same rate as if they owned one of each stock themselves. And what's great is that because their investment in the fund is divided up into shares, they can sell some or all of those shares to get their money back if they so choose. So here's what I'm thinking. We find a fund which owns the same stocks as the ones which are included in the S&P 500, and we buy shares in that fund. That way, even though we only own a very small fraction of each stock in the fund, our money will still grow by the same percentage as it would have if we owned a full share in each S&P 500 company ourselves. This is a compromise, but it makes sense for what we want to achieve. We don't want all of our eggs in one basket, and all we care about is spreading out our investment across the most valuable companies in the United States in order to protect ourselves in a recession. This option allows us to do that. Now, before we start looking for a specific index fund to invest in, I just want to spend a bit more time making sure that we've considered everything that we need to consider. Okay, there is one more thing we need to talk about, and it's this idea of weighted index funds. So if you actually look at the list of S&P 500 companies, which we were looking at earlier, you'll see that each company has a weight number. Apple has a weight of 7.3%, Microsoft is 6%, Amazon is 3.4%, etc, etc. These numbers are calculated by taking the value of any company in the S&P 500, dividing it by the total value of all companies in the S&P 500, and multiplying it by 100 to turn it into a percentage. Now, the reason why this is done is because it's generally accepted that the stock performance of the most valuable companies should have the greatest impact on the performance of the index as a whole. So the performance of Apple stock is going to have a much bigger impact on the S&P 500 as a whole as compared to the performance of Exxon stock. So why does this matter to us? Because this is how the S&P 500 index was designed, most of the index funds which we plan on investing in copy this weighted approach. In our example from earlier with the 40 investors, we assumed that the $88,000 was used to buy one share in each company in the index. But in reality, that's not how most index funds operate. Instead, how much of each stock the fund owns is based on the company weightings within the index. So as of recording, the value of an S&P 500 index fund will be made up of 7.3% Apple, 6% Microsoft, 3.4% Amazon, etc, etc. And over time, the people managing the fund will rebalance how much of each stock is owned to make sure that the weightings are all up to date. This presents a dilemma for us. We originally set out to own every stock in the United States, and we then narrowed this down to just the S&P 500 because of time and cost. But with these index funds, even though we will own a small portion of each stock, we'll own a lot more of some stocks than others. Even though we own some Exxon, we own a lot more Apple. And the reason why that's potentially a problem is because the investment is less diversified, less spread out than it would be if we allocated an equal amount of money to each stock in the index. In fact, the 10 most valuable companies in the S&P 500 will account for around 30% of the value of an S&P 500 index fund, which does increase the risk of being negatively impacted should one of these 10 companies run into serious financial difficulty during a recession. Now, there is an alternative, and that's an equal weighted S&P 500 index fund. With these funds, each of the 500 stocks will always represent 0.2% of the total value of the fund. That means the stock performance of the most valuable company, which is Apple, will have the exact same impact on the fund's value as the stock performance of the least valuable company, which is Embecta Corporation. But we're not going to go for an equal weighted fund. We're going to go for a normal weighted S&P 500 index fund. And the reason why is because even though it's technically more risky to be so concentrated on just 10 companies, if there is going to be any company who will survive the recession, it's going to be one or all of the 10 most valuable companies in the US. And if there's going to be a company who doesn't survive the recession, it's likely going to be one of the least valuable companies on the list. So in my eyes, it's actually safer to go for the weighted option because we're betting on the most valuable companies surviving. With that in mind, we now need to figure out what fund to invest in, and we also need to see how expensive it's going to be to invest. Alright, so I've done a bit more research and I think I know what we're going to do. So index funds can be offered as either exchange traded funds, also known as ETFs, or as mutual funds. I've already decided that that we're going to be going for index fund ETFs, but let me explain why. Obviously, what we're trying to do here is to buy shares in an index fund. With an ETF, the index fund shares are traded on a stock exchange just like any other company stock would be. That means we can use our brokerage app from earlier to buy them. Whereas with index funds offered in the mutual fund format, you have to buy the shares on dedicated websites, making it a bit more awkward. But my biggest problem with index funds offered in the mutual fund format is that many of them have minimum investment amounts, often in the thousands of dollars. ETFs don't have minimum investment amounts, so I decided that we're going for them. So then the question became, which S&P 500 ETF are we going to invest in? I happened to find a great video about investing in ETFs, and after watching it, I realized that not all S&P 500 ETFs are made the same. Different ETFs charge different fees for owning the ETF, they use dividend income in different ways, and some ETFs are only available to investors living in certain parts of the world. This video helped me to figure out that what I'm looking for is an S&P 500 ETF that reinvests its dividends automatically, that is based in Europe, and that charges very low fees. That should narrow down our search, so let's have a look and see what we can find. Okay, so I found two ETFs on DEGIRO that I'm interested in learning more about. So we're going to look up their fact sheets, which is essentially an information document, and we're going to compare them to see which one is the better option. The first ETF is called the iShares S&P 500 Euro Hedged UCITS ETF Accumulating. My god, that's a mouthful. Anyway, it's currently trading for €92.78. So right away, the first thing I'm noticing is that it's only going to cost us €92 to invest in this fund, compared to the $88,000 it was costing us earlier to own one share of each company in the S&P 500 directly. Obviously, this is much more feasible, and as we know, that investment of €91 will be spread across all the different companies in the S&P 500. But I want to know a bit more about this ETF before I consider buying it, so I'm going to look up its fact sheet, and how I do that is by taking its ticker symbol, which is this little identification code here, IBCF, and placing that into Google followed by ETF fact sheet. That brings me to this document here. Right away, I can see that two of the key benefits of this particular index fund are diversified exposure to US companies and direct investment in 500 leading US companies, which is exactly what we want. Then on the sidebar, we can see that this fund is accumulating, and that means that any dividends which the fund receives will automatically be reinvested, which is best suited to me for tax purposes. And finally, we can see that the total expense ratio of this fund is 0.2%, which is the total cost of owning this fund, meaning if we were to buy 1,000 worth of stock in this fund, we would pay €2 in fund costs each year, which is very low. Let's compare that to our second ETF, which is the Vanguard S&P 500 UCITS ETF USD Accumulating. This ETF is currently trading for €78.13 and has a ticker symbol of VUAA. So again, we look up its fact sheet and we're brought to this document here. Notice the percentage makeup of each stock within the fund. It's very similar to the S&P 500 weightings which we saw earlier, and the reason why these aren't identical is because this document is from the end of June, whereas the weightings on the website are updated daily. So it just goes to show you that the fund's weightings are constantly changing over time to match the index. Again, we can see that this is an accumulating fund, which is good, and we can also see that the total expense ratio, or ongoing charges figure as it's called here, is 0.07%, meaning if we were to buy €1,000 worth of stock in this fund, we would pay 70 cents in fund costs each year, which is cheaper than our previous fund. Okay, so we need to make a decision because we're running out of time. Even though the second fund offered by Vanguard is less expensive to own, I'm going to go for the first fund. And the reason why is because of the third benefit that this fund offers: USD exposure hedged back to euro monthly. Now, because I'm not from the US, when I invest in the US stock market, my investment returns are impacted by changes in currency conversion rates between the euro and the dollar. In other words, if I were to invest in a US company and over a period of 5 years my investment increased in value by 20%, but the dollar decreased in value by 10%, then my actual return would only be 10%. So this fund essentially removes the effect that changes in currency rates will have on my investment returns as someone who uses the euro. And I think that makes more sense because what we're interested in for this video is the performance of the 500 companies in the S&P 500, not the performance of the dollar against the euro. So with that being said, we're finally going to go ahead and buy one share in this ETF. And just like that, we now own the top 500 most valuable companies in the United States. That should do nicely in any recession. I set myself this challenge to see whether it would be feasible to invest in every stock in the United States. And the reality is that even though it would be possible if you had enough time and money, there's just no need to do it because we have index funds. The big takeaway here is that investing in index funds is convenient, it's low cost, diversified, and efficient. And not only is it cheaper than going out and buying lots of different stocks individually, but it's also much quicker. And just like how we found an ETF for the S&P 500, there are lots of other ETFs which allow you to easily access other segments of the stock market across different geographies and sectors. So it's a super beginner-friendly way to get started with investing, and it's been supported by investing legends like John Bogle and Warren Buffett. But now it's over to you. Has this video gotten you interested in index fund investing? Do you have any questions about index fund investing that I didn't answer? And if you're already investing in index funds, which ones and why? Let me know in the comments. So I really do hope you enjoyed this video. If you did enjoy it and want to see more like it, check out either of the videos popping up on screen now. If you want to become a supporter of the channel, consider subscribing and leaving a like on the video. That's all from me for today, but I'll see you in the next one. Cheers.